Welcome to the Capital Discussions Roundtable. I'm Tom Nunemaker with our guest Matt Amberson from ORATS. Before we get started, just a quick disclaimer that Capital Discussions is not a broker-dealer or an investment advisor. This presentation is for educational purposes only. We don't know your situation and have no way of knowing what level of risk is appropriate for you. We're not making any specific trade recommendations. The risk of loss in trading options can be substantial, so please be aware of all of your risks prior to placing any trades. Hypothetical computer-simulated trades are believed to be accurately represented. However, actual profit or loss may vary due to market factors such as liquidity, slippage, and commission. And once again, it is for educational purposes only. So with that, I'll stop sharing my screen and pass the presenter role over to you, Matt, so you can share your screen. And I want to welcome you on. I don't think you've been on our roundtable before, so it's nice to have you here, and maybe tell people a little bit about yourself and what you guys do.
Yeah, thank you very much. My name is Matt Amberson. I went to Chicago for graduate school at Kellogg, and then went to the floor of the SIBO back in the 90s and was one of the first ones, what we call hardwired. We were able to get information directly from the exchanges, and we parlayed that to a programmatic method for calculating theoretical values. We calculated some of our own proprietary data back then. For example, I was in a pit with a high-flying NASDAQ stock called Fleet Call, Nextel, and now it's Sprint, but it moved a lot during the day, and I didn't feel that the close-to-close volatility was accurately reflecting the true volatility, so we calculated based on what we were doing. The term scalping gamma is when you have an option position, and when the stock price changes, your hope for the stock to go up or down changes. So basically, when it goes up, you want it to continue to go up, so you might sell stock against it. So that's called scalping gamma. So we came up with that profit that you received from buying and selling intraday. We turned that into what we thought was a more accurate volatility. And from then, we built a whole backtesting database, forecasting of volatility, analyzing the put-call strike skew among hundreds of other proprietary calculations. And now we stopped the trading and turned it into a research platform called Option Research and Technology, ORATS, at ORATS.com. And our biggest business these days is, pensions, wealth people, and high net worth individuals trading options will come to us to backtest option strategies. We have a platform that we work with the individual usually, and we design or help them design ways to look at various option strategies. I'll be showing a little bit later, how you could put in your own signals when to buy, when to enter and exit a particular strategy, and we produce statistics, show you the trades, help you do graphics, etc. So that's a bit of a nutshell. And if there are any questions on that, or I wonder if you could see my screen yet too, Tom.
I don't. Did you share it yet? If you go on that share menu.
So let's see here. Share my screen.
There we go.
Okay. Cool.
Yeah, I used to work with Casey Platt a long time ago, and he was always a big fan of gamma scalping.
Well, Casey is a good friend, actually, and I've actually done a webinar with Casey. So hello, Casey, if you listen to this.
I don't think he is. He went off to do some kind of software development thing 6 months ago. I don't know if he's still doing it, but I'll have to look him up and talk to him. It's been a while.
Yeah, definitely. We go back to the 90s as well. So anyway, you're seeing my screen now. I happen to have open our what we call our option wheel trade finder. So one of the things that we do here, along with the back testing, is present out. This is just the SPY We show a open, high, lows, close graph, and then we show a distribution. Um, just a quick note on, option pricing. As many of you know, the Black-Scholes formula has weaknesses, and much of the research companies and the research that individuals do are to make up for that shortcoming in the Black-Scholes model. Like, for example, they assume a normal distribution, and as many of you know, stocks don't move in a normal distribution. They often have a fatter left tail, which means stocks go down faster and larger than expected. And what we've observed is a larger, more spread out distribution than a normal distribution. So one of the things that we do, and you can see it graphically here, is look at the actual distribution using historical stock price movement and put those in, we call little segments, and then you could see what the distribution looks like. And it's often tailed on the top and tailed on the bottom. And then you could click on different days to expiration, and it will calculate how that distribution looks. And I think it's an interesting way to look at and set up trades. So basically what you're doing is you're saying, okay, if we assume that this distribution holds up, there's a 15%. Let's see if I could. Oh, I could draw. This is a lot more fun when I could draw things. So, so here's the stock going up 6% between now and August, with a 15% chance, and here's the stock going down 6.6% with a 23% chance, and now that chance has been calculated off of historical returns. And now what you could do is you could simply pick an option and multiply what it looks like, what its profit is, up 6.6%, multiply it by times 15%, and that's a classic expected return profile. And this is what we do for all the options within kind of this range here, strike zone as I call it. So what we've found just for this particular one, if this distribution were to hold up, then the 250 call, the August 250 call at 99 cents has a potential profit, based on this distribution, valuing it, it might be worth, $4 up here, $3 here, and you multiply the $4 times 15%, and your expected or potential profit is $1.19, and that's how you get the 121. You divide 119 by 99. So this is kind of an interesting way, I think, to analyze particular trades. So this is called our Trade Finder. This is available or just hitting the market now. This is a relatively new product. This is the reason I was looking at it, and it's kind of nice because it shows you. You could scroll and see where the stock has been. You could see where the volatility, the green is the implied volatility graph, and the yellow is the historical volatility graph. So right now, as many of you know, the implied volatility is low, but the realized or historical volatility is especially low. And you can maybe see that as I use my cursor, that the last 20 days have been trading at a 590%, and the interpolated volatility is about 871. And then these dots represent implied volatility points. So this particular program is receiving data from our API. We have an API that's if you use Excel, you can go into our API, and I'll just go there quickly. And so here's an Excel sheet. Let's go try to find those expirations in SPY right now. So here are all the expiration dates. You can see it's pretty quick. Here are all the expiration dates, and then here are all the volatilities at various delta. So the at the money is the 50 delta, and you can see where we're getting this, these various monthly or expiration volatilities ranging from 8.5 all the way up to 14, almost 15, and that graphed on our trade finder. So you could see you can drag this and you could see how the longer dated skews are much higher. And the way I like to visualize it, so this is 372 days, so this is a long way for the stock to move, but you could see how these implied volatilities are quite high as you get out here. So that's a quick overview of one of our tools that we utilize. What I'd really like to talk about, and I think is our most powerful tool, is our option backtester, which utilizes a lot of the information that we showed and does this as you set up your strategy. You could go back and simulate how you would have traded it historically. But first, I want to just throw it out there. Tom, am I on the right track? Is everyone following? Should I explain more, explain less, move faster or slower? How's it going?
Pretty good. I mean, our community is pretty advanced traders, so I'm sure they're keeping up fine.
Okay, excellent. So I'm going to move past the Trade Finder tool. If you have any other questions, my email is matt@orats.com. So I'm happy to get into more detail if that be. But now I'd like to jump to something that's near and dear to my heart, our backtesting platform. And I understand that some of you are using other types of backtesting platforms. Ours is a little more what we call bespoke or customizable. So we didn't spend a lot of money on a web interface, although we are putting together a web interface now. But we actually just use CSVs to communicate. So I'm going to show you an example of a CSV that we use to communicate. And there are examples of this on our website, so I'm just going to go back to our website real quick. So here's the ORATS.com website, and if you go to documentation and go to backtests, there are examples of what I'm about to show. So this is how you would set up a particular SPY short call with a 30 days to expiration and 2% out of the money back test, for example, or a TLT, short 45 days to expiration, 30 delta, and only trade it when there's the implied volatility is at a 50 rank or outside of that. And then you could also backtest multiple symbols and iron condors and even a customized if you have a not unnamed strategy that you're trading. So yeah, that's where so on our site there is more information about some of the inputs, but I'm gonna go over one just to show you kind of what I would think is the power of our backtesting software. Like I said, I don't see anything else like it out there. So the first thing, the standard things, you email it in and then we run it, send it back. One of the things is that you could change is entry days. So how are you trading this strategy? Are you rolling it? Are you putting on, for some of our longer tailhead strategies, our clients find that if they put it, an equal amount on every 30 days, it keeps the trade fresher. Okay, someone just asked, I could see questions coming in. That's pretty cool. Someone asked for a butterfly 10 points wide, and I could show that in a bit. Let me go through just an easy example right now. So this is the entry days where none means you just trade it sequentially. So as you get out of a trade, you get into another. What we do sometimes is we'll do a one-day entry day, like enter a trade every day just to smooth out the return so we could see how the strategy is performing over a long period and it smooths out the returns. You can imagine if you were only trading once every 90 days and you were trading a put, how if the stock went up a lot, the put would no longer really have the same optionality as when you put it on. For example, if you put it on at a 30 delta, it's not going to perform the same way as if the stock went up in the interim as it would if this, for example, the stock went down right now versus if it went down after going up 20%. So this is a way to kind of smooth out your returns by changing your entry days. In this particular one, we're selling a call, and it's 30 days to expiration. We give it a min and max, so 20 to 40 days, and we'll find the expiration that's closest to the 30 days, how that works. This happens to be a 30 delta, and again, similar. We'll find all the options that match, and then we'll pick the one in between 20 and 40 delta, and we'll pick the one that's closest to the 30 delta. There are some more advanced, what we call exit strategies and then reentry strategies. I'm going to choose not to talk about that right now, but just know that, for example, if you were trading this 30 delta and you had an exit strategy, if the delta went to, let's say, 60, some people might want to re-enter the trade at a 40 or 50, the next trade if they were called out. So that's what that means. You could use deltas, or you could use out of the money percentages. Again, it works a similar way. I think I mentioned 2% before. You might say with a low of 1 and a high of 3, and you would pick the 2%. And then again, there's some re-entry strategies on a percent or delta re-entry. And then just to kind of quickly go through some of these other, here's that IB rank that you can enter. You only want to enter if it's, within an IB rank amount. If the spread price minimum or maximum, you can optimize for that. The spread delta, so that we looked at individual deltas for each leg, and now you could set the delta for the overall strategy. This one only has one leg, so it would be the same. Spread yield, I like to use that, especially for tail hedging. So we will only want to pay a certain amount as divided by the stock price. So, for example, if we're buying puts, we don't want to pay more than 1%, for example. And then where do you want to exit? Exit at expiration, or you could exit a certain amount of days into the strategy, or you could hold it for a particular amount of days, or you could exit if you have a certain profit min-max, so if it goes in your favor or if it goes against you. Usually what we're using is we're exiting at a certain delta. So if the delta gets down to 10 or 5, we want to test that strategy, or if it goes up to 60 or 70. And someone asked, is it end of day? The data that we use is okay, good. So I'm liking these questions, but slow down for a second. So we use close to end of day. We find that those are the best markets, but people like to have it near end of day because they're often using some global hedging. So what we've done is about 10 minutes before the close, we take a snapshot. We clean the data very well using various techniques. We've been doing this for many years, and we do, like I said, a bunch of calculations on this. And so let's see, what was the other question? Signals. Yeah, I'm just about to get into signals, because this is what I think the most powerful part of our trading platform is. So here's some other exiting, and you could actually even delta hedge each day at a certain delta. So now I'm going to get into some of our more powerful parts. So you could set up your own. So we're doing these for some of the biggest pension funds in the United States, actually in Canada, are talking to us, and we've actually done testing for. But they'll put in this is just the OEF, I think, but they'll put in their weightings that they have, and then they'll want to do overriding systematically, not all the time, but if it looks like, for example, Apple is in a good technical, I saw a question come up, good technical place. So what you're able to do using our software is you're able to use, so here for Apple, we only want to be in the strategy that I just showed on the, over the last 10 years. So we have 10 years of data, just these times. So Apple has been a terrible stock to overwrite, but if you use technical indicators, you can improve the results of, say an Apple that's going up pretty strongly. So I believe that was the question that came through. Can you use technical indicators? The answer is yes. You feed it to us via the CSV, when to get in and when to get out. And then you could also tell if you want to get in exactly at that date or get out exactly at that date or not, or just continue to do the strategy within those dates. So this is an example of the inputs that we have. So input is a CSV. Yep, for filters. Yep. Someone just asked. So it's this CSV is essentially the filters. So so now I'd like to show you, just an example of the output of a test. So let me just find something here.
And while you're looking for that, I see you have an API. So can you input stuff from a CSV or API?
Yeah. So the API, I'm not a programmer. Well, I'm a macro programmer, but not a real programmer, if that makes sense. So if you go to our site, we take JSON requests, So if that makes sense to programmers out there,
it does.
You could send us this information in a JSON call. So that's as much as I'm going to say on that right now. Yeah, I mean, we have some really talented programmers working for us, as hopefully you've imagined, to do all this. So anyway, the output. Let me show you just some of the output that we'll show. So we'll show something. Let's see here. One second. And okay. So what we'll do is we'll say, okay. We will, show. So first of all, you can run a lot of strategies at the same time. So for example, back to that, the CSV that sends us the filters. You may have seen various exit strategies. So these 4 exit strategies times these 3 exit strategies, that's 12 different permutations of this particular strategy. You could also put in different deltas, different days. As a matter of fact, we just completed a 20 million back test number of back tests for a client. So you could you would put 20 days to expiration, 10 days to expiration, and then the min maxes or 20 delta, 10 delta. So this is a very quick way to to send us many different strategies, and then we present that by saying, okay, so here's what I'll just sort it. Here's the the best one in this particular case was the 30 delta 30 day exiting at a 90 delta, and so you could see that all these were negative too. So like I said, for this particular strategy, selling calls didn't quite work out when this particular list of stocks that we tested for a client went up quite a bit. But what we're doing here is optimizing, what are the best strategies. And then once you find a strategy that you want to look closer at, you could look at something like just the strategy, and then we tell you what the Sharp is, and the drawdowns and the number of trades, the win rates, and a bunch of other statistics, and then kind of the monthly annual returns, the yearly annual returns, and the yearly sharps. And then we also give you the actual trades. So here are the actual trades in this particular strategy, the entry date, the exit date, the profit, and then you can look at as many things as you want. But it's interesting to see, the various symbols and strikes, the deltas. The average delta here is 29.7. So this is the 30 delta. So this is what I was saying before, how we optimize on that 30 delta. And then here's when we exit, and here's the expiration. So this was, I think, an expiration trade list here. So this is the output to expect, and those the monthly. This is kind of what hedge funds look like, and then here's how you could sort through hundreds or thousands of different strategies to see which one works the best, and then you could filter. Like what I'll do is I'll often look at, okay, here are all the months, and so then you could filter these down. Well, I don't, and then the annual returns. Well, I might not want any annual returns that are less than 4% for any particular year. Then you would filter down and find the best strategy for you. Another thing that we do is we'll develop strategies where we'll combine this strategy percentage with another percentage. So maybe we'll have a tail with a selling, a tail protection with a selling shorter dated or something, and then we would combine the strategies to see which ones fit together and produce the best sharp, and then recalculate the sharp, recalculate the annual returns, etc. So as you can see, hopefully, a very powerful system. It's a little, like I said, bespoke. It's not as user-friendly, so to speak, but you get all the data there to then recrunch or, so this is how we're developing systems for, like I said, some of the biggest banks, biggest hedge funds, biggest pensions out there right now. So with that, I'm going to pause for a second. And Tom, where can I see the questions?
If you go up to the top, you should see a chat button.
Yeah. Okay. Oh, yeah. Okay, good. So let's see if I missed anything.
Well, I had one. What kind of symbols do you have available? Do you have indexes and futures options, for instance?
Yeah, so we do all the U.S. equity options. So the I guess the futures options would be the SPX and VIX, but we don't do anything on the equity options. Not that we don't do commodities or anything like that.
So like ES futures options would be out.
Yeah, we don't do those.
Okay.
So can you show me how you would test a butterfly 10 points wide? So I think you could even go to the website and look at the examples. Let's see if we even have that in here. Yeah, it'd be kind of close to this one right here. So,
yeah,
so
butterfly's like a condor.
Here's a condor, and then the relationships and min maxes and such. So, so can you import ES or CL data as a CSV for testing? I'm not exactly sure what that means. What I will say is...
he's talking about the ES minis and the crude oil futures.
Yeah, not really, because we have such a intricate backtesting platform right now that we really it doesn't work like that where you could just put the trades in. Just so you know, what we're doing is we clean the trades, and then we run our summarization on it. For example, what I showed earlier, we're calculating very good Greeks. We have our own dividends and yield rates. We produce theoretical values. I'll kind of show you what that looks like. So here's Apple. So this is what we're scanning on, and the reason our deltas are good is because we have a very good what we call a smoothing volatility, where we solve for the put call parity. So there's a lot of this is an old apple. That's funny. By the way, one of the things that you could do with our API and with our current API and Excel tool is go back, historically. So I was able to type in apple, 1412, and you could see it was 400 at that point. Or I could just type in apple right now, and it'll go get the delayed data that we put out. And then, like I said, we're constantly summarizing the implied volatility skew, coming up with, and then that helps us create, good deltas, gammas, thetas, and vegas and such. So, yeah, it's not the reasons that we don't do a lot of outside crude oil or whatever is we think we our procedure for really drilling down in the equity space, gives us a competitive advantage in the data that we can expose then in our in the filters that we looked at earlier. So that's the answer to that. Let's see if we got another question here. Yeah, so incorporate underlying technical analysis filters. The way you would do that is to, like I said, do it offline and then copy your buy and sell indicators into our CSV. And we do have clients that do that and really enjoy that functionality, because then you could test, if it's a bullish strategy, you could test calls, buy rates, verticals, etc. And butterflies. I could. I don't have an example right now, but like I said, if you want to email me, a test that you might be interested in, we could usually set it up, and then, we generally have served the institutional clients mostly. We are moving to higher retail and sophisticated retail. And we want to be somewhat competitive, but also understand that we're a smaller group. We're not really set up like an Option View or those other types of firms. So we'll be probably more expensive than Option View, not terribly expensive, because they look, but we'll be able to provide some decent functionality as well. So like I said, if you're interested in some testing, we'll do an easy one just to show you how it works. And if you're interested, then we'll look for some type of a yearly subscription for retail. We do like a minimum of $1,000 a year, and then you get a certain amount of tests for that amount. So you'll get 100 tests for that amount, and then you kind of have to reload like a Skype account or something. So that's how we're working it right now. I'm trying to look for any other questions.
Oh yeah, Andrew just asked, do you support trade adjustments in the back testing?
So trade adjustments. Do you support?
Like if your short put gets to X, then do this.
Oh yeah, so that's the exit part that I touched on a little bit. So yeah, thanks. It's a great question. So what we have is the ability to exit a strategy if it gets to a certain point, and then you could either roll into the same strategy or re-enter at a certain other delta. So and then you could see that in the trade, in the trades that we expose to you. So you'll see, for example, in this trade, you'll see, okay, they exited at a certain delta, and then they rolled into this. So you'll be able to kind of go audit what we're doing, based on the inputs that you put there. So hopefully that's what you meant. And then I see that, do you smooth option markets to make them more accurate for XPX? Yeah. So that's a really good question too. So actually, let me make sure that I answered. Is that from
Chuck?
Andrew? So was this
Uh,
from Andrew? So hopefully,
Chuck had a question about the option pricing with the
yeah, I'll
SPX.
get into that first, but I just want to make sure that that's what Andrew meant. So,
Oh, the adjustments.
yeah,
Could you have an adjustment, say, the short put gets to X, then add a debit spread or something like, kind of add to the position?
Yeah, we that gets super complicated. We are looking at that, but we don't have that yet. The best we could do right now is if you get out at a certain delta, you could get in at a different delta, or if you get out at below that, you would get in at your original strategy.
Okay.
So let's talk about option pricing and for the SPX, because that's a really good question. Because yeah, one of the points, one of the things that we see is when you, especially in these illiquid markets, and I'm going to close this for now. The prices are so wide, you don't know where, you don't know what the true value is for that, for example. So one of the things that we do in our smoothing, to create decent Greeks or even a theoretical to compare yours to is to do that smoothing procedure. Like for example, Apple's not a very good example, but I don't know if anyone. I mean, I could do SPX, but so let's just talk about SPX for a while. So SPX trades based on a futures for each expiration. Each expiration, I don't even think has it. These weeklies don't have their own future. So what we do is we solve. So for SPY, you could see that the stock price is the same for each month, but for SPX, we solve for the future. So for example, you'll see that the price 24.31 goes down to 23.81, and we solve based on put call parity and to make that to find that implied futures, and then also to make very good Greeks based on it, and also to smooth like we're doing here. So I'll just let me format this a little bit better so you could read it. But so one of the things that we do is for each delta bucket, so 50 deltas, 55, 60, 75, we're drawing that skew, that line through, and as many of you know what it looks like. So there'll be an option bid ask here and here and here and here, and whereas this is IV and this is the strikes. And then we'll draw a smooth skew through this, and then what that will do is allow us so it doesn't get crazy maybe at the wing where this would throw off some deltas, Greeks, theoretical values, etc., that might throw off your ability to manage your risk, etc. So in the SPX, we'll just go down. I think the question was when it gets really wide. So what we're doing is we're drawing this call value and this put value, usually over 90% between the bid-ask spread, and then this is the value or this volatility is the volatility that we calculate our Greeks with. So very important for backtesting, exiting on, keeping your Greeks good, because we're exiting on these out of the money Greeks sometimes, and if your Greeks are flying all over, you're going to exit when you probably don't want to exit, if that makes sense. So hopefully that answered the smoothing question.
Hey, Matt, do you have a timeline of that? You said you were working on a web interface for your back tester. Do you have a timeline for that?
Yeah, so it's in production right now. We're testing it. it's basically just helping us make the CSV to send back and forth, and then we'll have just some basic graphs and tables to show how the strategies perform. Okay, good. There's another good question here, Tom.
Yeah, I see
Neil. So Neil is asking, when you do a back test, do you assume the trades are at the mid? And the answer is no. We have assumptions that you could actually override. We're currently using 75% of the bid-ask spread, but you could. So you travel 75%. If you were only traveling 50%, you'd get to the mid. If you travel 75% to trade, so you're selling closer to the bid and you're buying closer to the offer. And then we also have a $1 commission rate put in there as well. So we assume commissions, and we assume commissions, and we assume slippage. So hopefully that answers your question, Neil. So
I had a question on the 100 back test. Is that 100 times you submit a CSV file? I mean, will one back test have multiple results, or just one result?
Oh, that's a good question. Actually, let me defer that. But it's if you send multiple ones, we don't have hard and fast rules on that. I think if it's less than 20 or 30, we'll count it as one. But if you have too many, then it takes more server time.
Right. Looks like we've run out of questions.
So anyway, I appreciate this opportunity. My firm is a small firm, but we have some very adept programmers and traders that have put this together, successful traders over time. Like I said, we've concentrated on these institutions, but we're moving towards the more sophisticated options traders, individual traders now. So there's a good opportunity for us to start working with clients like yours, and you could even help us in the development of in how these perform and the pricing and all that. So we're not a big company, but we have a very, very powerful back testing engine. It's all cloud based, so we can scale up very quickly. People are using it, and if there's any bad data, we hear about it right away. So, and we've, like I said, had a lot of experience in cleaning. We have very good dividends. Actually, one of our products is a dividend feed. So we have very good people that we work with. These are all super important for back testing, having all the right assumptions in there. You guys have asked really good questions. And like I said, I think back testing is an essential way to practice trading almost and improve your intuition. It's a great educational product, and then it can serve to help you design systematic strategies. That's how you need that competitive advantage in the market now. And I also think that utilizing those signals and technicals also give you a competitive advantage. So if you look at our kind of graph here in our Trade Finder product, you could say, well, when the volatility comes up and comes down, that's a good time for maybe a bullish call spread or selling a put spread or something. Signals like that are the thing that excites me, and where I think that traders like us, I trade very small in my own personal account just to keep up on all this stuff, but where we can really have an advantage, at least compared to the big boys, and I see a lot of the big boys. I also have I don't know if you guys listen to a podcast called The Option Insider. I've talked about our back testing tool there. It was in the Wall Street Journal a couple weeks ago. So in the industry, ORATS is a pretty good name. And then we got another question here about the next step. Yeah, trial. So, like I said, if you're interested, email me at matt@orats. I'll show you, what the procedure looks like, and then help you set up a CSV and get the trial is just seeing, what the output is and making sure it's going to work. And then what I'll usually work with you or, see if your CSV is going to work. If it works on its own, you get a free one. If we have to intercede, then we'll ask you to subscribe. And again, a subscription is $1,000 for a year.
And I notice you guys also have historical data. A lot of people in our community are also trying to do their own kind of testing. Can you spend a minute or two to tell us what you've got?
Yeah, definitely. So we actually offer it on Quandl for, I think, a really reasonable rate for our clean backtesting data. And like I said, it comes out like we saw it on our like we saw it on this. So it kind of looks like this data. We capture it all and store it. And then, on Quandl, let me just go to that real quick. So so here's Quandl, and if you go to ORATS, so we have volatility surfaces, which are kind of interesting, but also what we call our smooth market system. And the pricing, for a single user is $200 a month or $1,500 for a year. So you could download quite a bit of these CSVs for that. And again, they look like huge files of this, all the strikes, all the values in Greeks and such. So I think that's a really good way if you're going to test on your own, set up your own database.
And then Chuck said he heard you on the Option Insider. Says, have you seen anything trade well in the recent high skews and low IV and SPX, or things that aren't working?
Yeah, well, I'm not a option advisor, and this is only for educational purposes, as you disclaim. Yeah. But yeah, I mean, this is. I'll just tell you what we've seen in our back testing that even in these low environments, what I like to, constrained option selling, which is, I think that, kind of put spreads or call spreads still work. And I'll kind of point you to, these statistics that I'm looking at the implied volatility and the realized volatility is so low right now that, that's really what you're playing when you're selling vol. If it just sits here, you're going to collect. So that's what we've seen in the in these types of environments.
Very cool. Well, Matt, really appreciate you coming on and showing us what you've got. Lots of great stuff going on at ORATS, and hope the people at Capital Discussions can contact you and give a CSV or two a try and maybe improve what we're doing with our options. So many thanks for coming on, especially short notice.
Yeah, no, my pleasure. And again, if you have more questions or more interest, I'm happy to come back. So I had a good time.
Okay, great. Well, I really appreciate it, and take care. And everyone, thanks for being with us, and we'll get this recording posted. And thanks again, Matt. I'm sure we'll have you on in the future.
All right. Yeah, I appreciate it. Thanks, guys.
All right. Thanks, everyone.